Now, everybody, Cantonese Cat here. I'm back. Just real quick, I did a live stream just now with the great Matsby. He's got a YouTube channel. The handle for that is TGM Trading. If you want to check out his channel in general, I think it's a very, very good channel. He's got a lot of different technical analysis, and I collaborate with him all the time. We have another channel called Triumvirate Channel. We also have the Tesla Tracker that comes and joins us all the time. But I just did a live stream here, and we talked about the cryptocurrency market. We talked about some stocks too, like MicroStrategy, Shopify. We talked about Upstart. I actually have a very good chart for Upstart I was showing over there. So yeah, please check it out. Subscribe to this channel and check out the Cat in the Mat show, if you will. I just want to take a moment to show you. And first of all, I also wanted to thank you if you're a subscriber to my channel, and if you're also a member to my channel. I want to thank you for joining. I just want to do a quick kind of reaction thing to Tom Lee here. I feel like every single time he talks, I just want to do a reaction. So here we go.
So I look at your notes today, and you suggest the worst is behind us. What makes you think that?
Well, I think the thing that we're watching is the VIX spike to 60 on Monday, which is the third highest reading ever, and the VIX futures curve inverted, which was the steepest inversion since the pre-pandemic times. Both are starting to normalize. I think the VIX, as it closes below 20, and it hasn't closed yet, and as that VIX futures term structure uninverts, that tells us the worst of the panic is behind us. I don't think it means we won't have ripple effects, because we know there's some trapped bulls, and there's still some nervousness around Iran and how much of this yen carry trade has to unwind, but I think the worst of the selling pressure is behind us.
So this is actually a little bit unusual. I think there are probably more bears than bulls when it comes to the stock market, when it comes to people who go to CNBC and talk with them. Tom Lee is kind of like a little bit of a permanent bull. I mean, I think it's actually not a bad idea to, if you have to choose a side, I would choose to be more, bullish than bearish, just because overall, generally the market goes up over time, right? You're going to have some pretty brutal times that if you over leverage, you're going to get punished for it. But overall, even throughout, if you just take out the bleed from the great financial crisis and the dot-com bubble, overall the market goes up over time. So it makes more sense to be more bullish than bearish, especially when it just keep printing money anyway. You can see that this is the U.S. money supply, just can keep printing money anyway. So it's always better to lean a little bit more towards bullish than bearish. And the whole idea about people saying, oh, it's printing money is unsustainable. They've been doing it for like decades. They've been doing it for ever since there's a dinosaur here on TradingView. This is nothing new. Whenever you have growth in the economy, you're going to have a lot of deflationary forces. And the Fed basically just prints money based on how much deflationary forces. Sometimes they get a little bit too ahead of the game, and they print a little bit too much, and having some inflation. But usually they print to growth, and usually that's how inflation usually has been able to stay below 2% for a very long time. Especially you have other deflationary forces that's happening globally with China and everything else. So I just lean a little bit more bullish. Now they're talking about the VIX. The truth about the VIX is, if you just look at the let me see. You look at the monthly Bollinger Band, and you can see that really the VIX has only spiked up this high level for the entire history of VIX all the way dating back all the way to 1990, and a lot of things have happened since 1990. You're talking about a lot of world conflicts. You're talking about a lot of really crazy crap. You're talking about the dot-com bubble. You're talking about a bunch of stuff that happened, right? The VIX, this is the third highest level of the VIX ever since 1990. And you're talking about VIX all the way to the 60s, right? So that was probably a good opportunity to buy. And if anything, it's just closed back down the monthly Bollinger Band, right? It's just like a one-off, like a freakish kind of thing. A lot of people are worried about the carry trade, and Tom Lee's going to talk a little bit more about that. If you also look at the weekly, it just went way too far, way too fast on the VIX. Does it mean that this is over and we're going to keep on going down further? Not necessarily, but we did close the week with this big, giant, bearish shooting star candle, which generally means it's a pretty important top, which means that probably you might end up tracing up a little bit, but the trend for the VIX now is down because of this big, giant, bearish candle over here. And every single time where you get above the Bollinger Band here for the VIX, really ever since this bull trend for the stock market has started, October 2022, right? That was the lowest point of the NASDAQ. And every single time when you have these kind of corrections, it gets above the VIX gets above the Bollinger Band for like maybe 2 or 3 weeks, maybe a little bit longer, but usually about 3 weeks or so. And then that's it, right? So right now we have 2 weeks, maybe a little bit like a third week over here. So it does seem like the VIX scare seemed to be over. But we'll see. I'm going to keep letting Tom Lee talk here.
How do we know that we had just a growth scare and not something more dramatic to come, Tom? Never mind the unwind of the carry trade, and no one really knows whether that's over either. But when you think about those two events, what does it make you think about where we could go moving forward?
Well, I think investors, when it comes to the growth scare side, have something they can check every week, which is weekly jobless claims, because that's what was a positive surprise on Thursday, and a lot of it came from Texas. Texas had a big drop in weekly claims week over week. The fact that markets reacted so positively Thursday to that jobless claims number puts me in the camp that that's one of the big drivers, because we had a better than expected claims number and then the market popped. I think the growth scare is what's on investors' minds, and next Thursday they'll get another weekly claims number, and if that's also equally improving or stable, I think it's going to give people a lot more conviction.
What about the unwind of the carry trade? I mean, there's no real tell as to whether that's run its course, and that seems to be, the obvious catalyst at the beginning of the week for positioning being well off sides, and it just needed to correct itself.
I don't know whether or not you can really say that the worst is over, but there are a lot of really positive sides, at least when it comes to the U.S. stock market. It did end up closing back above the 20-week moving average, and it did end up closing back above, and this is SPY, it did end up closing back above the Kijun or the baseline up here. So there are a lot of really positive things. If you look at the monthly, it bounced off where it needed to bounce off, which is very, very strongly rising Tenkan. I think the stock market has just gotten way too far heated and it needed to kind of cool down, and exactly that this month by backtesting the Tenkan. And that's a very classic bull market behavior. In a bull market, whenever it runs a little bit too hard, you backtest the Tenkan, and it could go up a lot higher, So I think that's basically what it's doing right now. It's not anything super concerning. Could it go down a little bit further? Could it even go down a little bit underneath the Tenkan here and close a little bit underneath there, kind of like it did over here back in October 2023. That's entirely possible. Everything's possible, but I'm just not sure like this bull market is over yet either. And if there's any ongoing volatility moving forward, I think if anything it might be a little bit more of a buying opportunity moving forward.
Is it finished?
Scott, that's a great question. Nobody knows how big that carry trade could be. I think there is a large insurance industry participation in that, and I did speak to some insurance executives this past week. As their view is, there's a lot of financial institutions that actually implemented this trade, but if it unwinds in an orderly way, it's not disruptive. It's just that if you have weeks or days like Monday or last week, the end of last week, that's very disorderly, and that gets very expensive because these insurance companies have to take off these hedges, and then they suddenly have unhedged carry trades.
Well, I just want to continue this. You suggest, if it unwinds in a messy way, there's no if. I mean, we saw at least the first.
I hate to cut him off in the middle, but I don't know. I mean, it's just, I'm going to basically tell you like what the carry trade, if you worry about the Japan market, overall is on the monthly is still closing above support. Just zoom out here. You basically have hit the bubble level over here on the top, and you're not just going to expect to just come push through beyond that immediately, right? You're gonna expect to come back test some stuff here. Even if it goes all the way back down to the cloud, like, okay, I can see that happening. Like you're at the top over here during the 90s bubble, actually the 80s bubble, right? And you're going to have a hard time as a big psychological level it has to break above. And this is still a very strong bull market. Look at what happened over here since like April 2023. Like it really just shot up from like 28,000 all the way to like 40,000, right? This whole move needed to be digested. You're going to need to have formed a little bit of a higher low here. And it did. It formed a higher low compared to over here. So this is still a bull market. And if you're also looking at like the 2-week chart, and instead of looking at Ichimoku, if you look at like the Suppi Ichi, it bounced and found support where it needed to find support at, and it's just had a huge bounce above of it, right? If you're also looking at the Ichimoku cloud on the weekly here, it also bounced through the cloud underneath, and then it just had a big giant wick, and it closed the week kind of getting close to the top of the Ichimoku cloud here. This is a very bullish candle. because of the big giant wick underneath of that. This is a very bullish candle, like a hammer bottom. And generally, this favors more bullish continuation, right? Now, it does have a little bit of a katana down pointing here on a weekly, but I think this is a little bit of a delayed indicator. I think the big giant move has already happened. You do have some resistance above, right? You might end up hovering around the cloud over here, and this might become resistance. As it flattens, then you're talking about price might end up falling sideways over here for the Nikkei, for the Japanese market, forming maybe even a ascending triangle before pushing up higher. But I think this whole carry trade is actually a great opportunity for the whales in the Japanese market and the US market and the worldwide market to try to take your shares and grab liquidity from you. And they need liquidity, and they just grab it from you. That's all.
Reverberations from that unwind, and that was anything but orderly. What if there really is more of that to come, Tom?
Scott, there may be more of it. I think one thing that is been messy is the currency hedges, because these currency hedges were built for what you'd call like 1 percentile events, 99 percentile standard deviation. So a bigger move than that is what makes these hedges so expensive. They just let them expire. I think central banks can manage currencies within a 1 standard deviation band. So I think it's still important to watch currencies, but if we're staying in stable and predictable ranges, it can be a orderly unwind. But yeah, Scott, that's an uncertainty, just like the Middle East is an uncertainty as well. But markets climb a wall of worry.
Yeah. What do you make of how this week began? Not with necessarily the market upset, but the commentary around it, whether it was Jeremy Siegel of the Wharton School suggesting the Fed needs to come out and do a 75 basis point cut.
I'm going to talk about rate cuts here in a little bit, but if you also just want to look at like the USD over JPY chart, not USD, I guess, USD JPY. This is the US dollar over Japanese yen, and this is the weekly chart. Basically, it was just gone up way too far, way too fast, and it's unsustainable. This actually looks a little bit like the Nikkei chart, where it just kind of went down, and it backtest the cloud, and so far looking like a pretty decent candle over here. Who knows? Maybe the Japanese yen just going to continue to plummet against the US dollar. But I'm not really that scared about it. I think the trend looks like it wants to continue. But with that said, over the last couple of years, it's been backtesting the cloud a lot. And I do wonder whether or not at some point this trend would get exhausted. And the reason why I say that is if you are looking at the RSI, you can clearly see that as the USD continue to outperform the Japanese yen, there's a huge exhaustion of the trend, right? Like you can see that this has just kind of gone down over time. When the US dollar just keeps making higher highs, we have lower highs for the USD over Japanese yen pair. So I don't know how sustainable this is. I think this is getting a little bit exhausted. And even though you do have a pretty bullish candle over here to close the week, I think it might end up bouncing back above. And it could unwind in an orderly way, right? It could actually just end up going through the cloud and just end up underneath the cloud, backtest the cloud here, and then slowly go down. I don't think it has to be that much of a scare. I do think that this bull trend of the USD over JPY is probably going to be over soon, and that might coincide with the fact that the yields for the US is also plummeting. You can see that the yields are plummeting underneath the weekly Ichimoku cloud, right? And you have a little bit of a dead Cantonese cat bounce here. And that's completely expected. If you look at a monthly, you still have the rising Kijun as support, right? But you can see that this entire trend is also exhausting. So as yields, these are real rates which actually drive the market. I don't really care what the Fed does. They're going to follow real rates. That's generally what they do because they're dependent, and they're but the real rates are already doing the work for them. They're dropping. They have a little bit of a dead cat bounce, but it's going down further. So I think that if the Japanese government or the Japanese central bank doesn't do anything and just leave things alone and don't do anything unexpected, the US yields are going to drop over time and it's going to unwind and it should be fine. But that was a big buying opportunity this past week. Anyway, I'm going to let him keep talking here.
in an emergency way. Of course, he walked that back with our own Jeff Cox yesterday evening. Ron and Son at the beginning of the week suggesting the Fed needs to come out and say something that essentially we've got you back from a liquidity standpoint. Do they need to do something before September's meeting?
Scott, I think both comments from both Ron and Jeremy Siegel are actually valid. But to me, what it speaks of is I think the markets and I think economists are no longer willing to deal with data dependence. I think they want a Fed that's more forward-looking because that makes them comfortable the Fed could respond if conditions deteriorate. I think that's the kind of language I'd like to see disappear is we're data dependent, so that by necessity they're going to be very late. I think it's actually encouraging to see this sort of pushback.
Power E.
Yeah, I'm done. That was a pretty good video. I love Tom Lee, but I just want to say, like, everybody's probably giving too much power to the Fed. There are real rates you can follow, and they're already telling a story. 10-year yields already plummeting underneath 4%, and when that happens, mortgage rates are already dropping, and that could make some pretty big changes to the housing market too. You already have quantitative easing. Rates have already topped in October 23, and you also have the U.S. money supply that has already bottomed around October 23, right? So I just don't see this being an issue. People worry about recession. They're worried about the Fed being too late. They're worried about not having enough liquidity out there to help solve the problem. They already saw that coming, and it's already unwind. And since October 2023 up to now, there's already been $500 billion that have been printed, and quantitative tightening has already ended. So anyway, I just wanted to share with you my thoughts. I'm probably going to make this video members only for about a day and probably end up releasing it to the public. Thank you so much for joining my membership. If you'd like to do that, I would love to have you again. Just click the join button, available on Android and Chrome. And if you want to join, great. If not, that's fine too. Thank you so much for listening. Have a good one. Bye.